I'm Nichole Berlie. It is Wednesday, March 22nd. This is NewsNation Rush Hour. We start with another variable day on the markets. All three indices closing in the red today after the Federal Reserve's announcement of another interest rate hike. The Dow hit the hardest, falling 530 points. The Nasdaq dropped about 190. S&P down 65. The Fed raising rates by another quarter point, while at the same time signaling a year of aggressive rate hikes are likely nearing an end. Chief Washington correspondent Blake Berman is live in Washington. And Blake, how did the recent bank turmoil factor into all of this?
Well, Nichole, here in Washington today, it was really split screens for the financial world with real world implications as well. One side of the screen, you had Jay Powell, the chairman of the Federal Reserve, taking questions from reporters. The other side, the Treasury Secretary Janet Yellen, who was up on Capitol Hill answering questions from senators there. Powell, let's start with him. He announced the 9th consecutive interest rate hike, this time another 0.25%. That benchmark rate now at 5%. However, just as important, the Fed signaled that the streak of rate hikes could soon come to an end. The current projection is now there will only be one more rate hike this year. The Fed, as you know, has been raising interest rates to try to tackle inflation, but the SVB and Signature Bank collapses had many wondering if the Fed would throttle back. It's the first time today, first time really, that we've heard from the Fed chair since the collapses. Powell described the banking system as sound and said that people should feel as if their deposits are safe. Meantime, up on the Hill, the Treasury Secretary was pressed about the safety of bank deposits. Janet Yellen saying she has not considered or discussed the possibility of having all deposits insured, no matter how much money might be in that account. Nichole, it's pretty clear at this point in hearing from both the Fed chair and from the Treasury Secretary that they are trying to instill, or maybe in some cases reinstill, confidence in the American banking system, Nichole.
Yeah, certainly reinstill in many cases. Yeah. All right, so Blake, we've all seen how these rate hikes have impacted the banks, but what about consumers?
Yeah, not an ideal picture right now, Nichole, when you talk about American debt all across the country. Let us show you just some of the numbers and how it breaks down. Right now, debt is at $17 trillion collectively across this country, of course, upon which Americans pay interest on that, and that number has been rising for decades. For example, to end 2022, Americans held nearly $12 trillion in home loans, along with roughly $1.5 trillion in both student loans and auto loans. Credit card debt right now just shy of $1 trillion. As the Fed has substantially hiked interest rates, borrowing costs, of course, have spiked as well. For example, the average 30-year mortgage right now around 6.6%. That is more than double where it was just 2 years ago. Auto loans right around that figure as well, running around 6.5%. A notable increase, though not as jarring as housing. The Fed chair today, Nichole, said that when it comes to interest rate hikes, the impacts right now are being felt the most on the housing market and for business spending, he says. Nichole?
All right, Blake Berman live in Washington. Thank you for that. Thank you for watching. Go to newsnationnow.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.